Welcome to Fear and Greed, the week ahead. This is where we take a look at the big events, reports and releases coming up this week. They give insight into the economy and a look back at what happened last week too. I'm Sean Aylmer, and every Monday I'm joined for the week ahead by economist Stephen Koukoulas. You'll find him at thekouk.com and on Twitter using the handle thekouk, THEKOUK. Good morning, Stephen.
And good morning, Sean.
Now, how'd you go with the races on the weekend? I know there are a few horses that you were a bit keen on.
A couple, look, at the end of the day, I did very well. So a couple of good seconds and thirds, but also a couple of winners amongst it all too. So a lot of fun when you're in lockdown following what's the lead into the spring carnival. It's fabulous.
That's right. It's good when the good horses come back because then it's actually just a little bit more interesting.
It is indeed.
So tell me, the week wasn't such a big week last week, though the central banks seemed to dominate. We start with the Reserve Bank minutes before moving on to the US Fed. So sort of didn't really say too much new, I suppose.
Not too much new. They reiterated their view that they're confident that when the lockdowns end, when vaccination rates are 80% plus for everybody, basically, that the conditions are still positive for the economy, that I guess we're now talking very late 2021, so probably December, and then certainly into 2022. They're optimistic that there's enough in easy monetary policy, still some lingering fiscal stimulus, the Aussie dollar's in the low 70s region, and that's competitive for our economy. And they're saying that, we should be resuming that path to pretty strong growth, to getting jobs being created. And even though we've obviously got an air pocket in the economy right now, it's not as deep as it was last year. And even what we're seeing in some of the labour market indicators, job ads, job vacancies and things like that, which came out last week, there's not the same lack of confidence, I suppose, in the labour market. And that was something that the RBA was, reasonably confident would bode well when the lockdowns end.
Now, there were a bunch of central banks last week prognosticating, shall we say. There was the US Fed, there was Japan, there was England, there was Norway. I must say I did read that, though, and you didn't understand much of it. The big one, of course, was the Fed.
Yes, the Fed came out, and it'd be an exaggeration to say hawkish, but they certainly were talking. The chairperson, Jerome Powell, was sort of talking about tighter policy. The ending of the QE, so the tapering, was front of their agenda, their policy agenda, and even the discussion of maybe just sort of thinking about hiking interest rates in the next 12 months or so was something that caught the market's attention. And while we might have been focused on the property sector in China for some of the market volatility, at the end of the day, the Fed was pretty confident about its economy recovering. And of course, that's good news for the global economy because the US is really still the driver, even though, of course, China's an important part as well. So if the Fed's upbeat and the other central banks are a little more confident about the economic outlook, but in the meantime, keeping policy very easy, it does just reiterate what the RBA was thinking last week, and that is that 2022 could actually be a pretty good year for the economy. One other thing that's really, I think, interesting on that score too, while here in Australia we focus on iron ore prices, and rightly so, it's our dominant export, and its prices dropped by roughly 50% in the last few months, despite the volatility at the end of last week. If you look at the broader commodity indices, it includes oil, copper, aluminium, tin, a lot of
coal. Are we allowed to say coal anymore or
not?
Oh,
yes, I did. It was just a slip of the mind.
Uranium, some of the favourites.
But even ag prices.
Yeah, the soft commodities.
The soft commodities, those commodity indices are really, really strong. And that says to me that the global economy is actually growing and that inflation pulse is something that's there.
That was last week. We'll be back in a moment and get into the week ahead. I'm with economist Stephen Koukoulas, a.k.a. The Kouk. So, Stephen, what have we got on this week? Retail trade, I suppose, will be the big one.
The big one, yes, for the month of August. Look, it's going to be a soft number. We know that the lockdowns do cause people to shy away from the retail sector, even the online spending. While it's been really supportive of a lot of companies, it's not really driving enough of the retail sector, with hospitalities and other domestic tourism type businesses largely closed. So looking for a fall of about 2% for the month of August, and just reinforcing that hole in the September quarter numbers when they finally come out.
Now, before the break, we were talking about the employment market and job vacancies. We get more data on that this week. They've held up reasonably well. I mean, notwithstanding they'll probably fall, but they're probably not as bad as they could have been.
Yeah, look, these are the official ABS job vacancies numbers. Look, a fall of about 5% is in order, and that would put it in line with what we've seen from the ANZ series, from the Indeed and Seek vacancies numbers. And when we compare with what happened last year with the lockdown number one, if we can call it that, when job vacancies were falling 50, 60%, the peak to trough level in this cycle is probably only going to be around about 15, maybe 20% before that recovery comes through. So it says to me anyway that with the international borders closed, the foreign worker inflows basically at zero, that demand for labour is still pretty strong and they're sourcing their labour from the domestic labour force.
And there'll be a bit of news around housing this week as well. Obviously, we get the CoreLogic house prices, which we all love, but also the RBA credit data. And last week, Michelle Bullock, the Assistant Governor of the Reserve Bank, talked about, I don't know, the concerns is overstating it, but just talked about the idea that people were extending themselves in terms of how much credit they were accessing to borrow for housing.
Indeed, and she would have known these numbers that are coming out on the credit side, and they will show almost inevitably that credit growth for both owner-occupiers and, interestingly, investors is starting to step up again. The housing credit growth should be of the order of 0.6, 0.7 for the month, which, if we annualise that, we're getting close to double-digit sort of growth rates occurring again. And that's the sort of imbalance that I think Michelle was talking about. And the RBA, look, they're always worried about the impact of housing on the economy and financial risk and financial instability, but they'll be looking at it and sort of more at this stage of the economic cycle as a positive because it's helping the economy to grow. But I think it's more a question for, again, when the lockdowns end, will the Reserve Bank and the other regulators be looking at macro-prudential issues to cool this housing market down? And as you mentioned, CoreLogic put out their monthly house price series. It'll be another strong month, around about 1.5% increase in house prices, around about 20% annual increases in most of the big cities. And that's really, really strong in anybody's language.
It's great, isn't it? Stephen, have a great week.
Thanks, Sean. Same to you.
That was economist Stephen Koukoulas, better known as The Kook. You can find him at thekook.com and follow him on Twitter using the handle The Kook. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.